Our first speaker is Jake Klein, Executive Chair, Evolution Mining. Over the past decade, Jake has led the team which has grown Evolution into one of the world's leading globally relevant gold miners, with assets here in WA, New South Wales, Queensland and Ontario, Canada. This is the 12th consecutive presentation Jake has given on behalf of Evolution at Diggers, and we welcome him back to the stage. Thank you, Jake.
Thanks, Duncan. Welcome to Hangover Wednesday. It's great to be back for the 12th time. Thank you for reminding me, Duncan. Well done to Suzanne and the team for putting on really a great Diggers again this week. And thank you all for dusting off the cobwebs and making it here for day 3, start of the morning presentation. This morning I want to leave you with 4 very simple messages. And I believe they encapsulate the opportunity that is available for investors and for Evolution. And I give you a personal guarantee that you don't have to remember anything else from this conference other than these 4 messages. Last year at the conference, I said that the gold price would go above $2,000 an ounce, and it briefly did. Even better is the Australian dollar gold price, which is sitting around 2,950 Australian dollars an ounce. So Australian gold miners should be really, really happy. But we're not. Maybe it's envy because over the last 12 months, the so-called critical minerals like lithium, rare earths, and even metals like germanium, gallium, I didn't even know they existed, and niobium, have stolen all the headlines. But my first message to you today is do not forget gold. I actually thought of calling my presentation The Revenge of a Gold Miner. As you can see from this chart, gold is the world's second largest metals commodity market. And here's a bit of friendly fire back to my friend Amanda Lacaze, who spoke yesterday. Amanda, rare earths is not on that chart. No, and nor is lithium either. Gold is definitely a market worth paying attention to, and investors should have exposure to it. And whilst last year we spoke about the many reasons that were compelling to be optimistic about the gold price, this year there are even more compelling reasons why the gold price is likely to go even higher. I use what I've called the 5 Ds to try and capture the key catalyst to my optimism about the gold and copper price. The first 3 reflect the growing global financial risks, and the last 2 reflect a global realignment which is well underway. Today, I want to focus on the 3 catalysts that I think will have the biggest impact on the gold price over the next 12 months. These are debt rising, decoupling, and destabilization. As you'll see later in my presentation, decarbonisation will also be a key driver of higher copper prices. The chart on this slide shows the incredible correlation over 50 years between US debt and the gold price. So if you want to know where the gold price is headed, all you need to know is where US debt is going. On the left-hand slide of this chart, we have replicated what you can find on a wall in Manhattan, not far from Times Square, which shows you how much debt America is incurring. It started at roughly $40 billion just before World War II. Now each hour it rises by roughly $100 million. So by the time the dinner is finished this evening, debt in America will have gone up by $1 billion. So in what I feel is a much safer prediction than the one I made last year, I guarantee you that by the time we come back for Diggers in 2024, the chart will show that US national debt is even higher, and as you can see, that is a very, very good indicator for the gold price. So the gold price will be higher next year. This slide really troubles me. When I first came to this conference many years ago, I was presenting Sino Gold, a company exclusively focused on gold mining in China. It was exciting times. We were building new mines in remote parts of China, and the growing engagement in cooperation and investment between Australia and China were the key themes of the conferences at those times. This culminated in a free trade agreement between Australia and China in December 2015, and maybe this marked the peak of the relationship, because ever since then it feels like it's been downhill. And this chart really shows it in stark reality. In 2017, close to $300 billion was being raised and invested in China. Today that's fallen to less than $30 billion. That's a 90% fall. The inconvenient truth of all of this is that the world unfortunately seems to be polarizing into two very adversarial groups. Another clear indicator of how divided the world is becoming is this chart, which shows the shift in the way central banks are managing their gold exposure. In the period of globalization, there was little reason to invest in gold, as the US dollar presented a safe and reliable alternative amid generally good macroeconomic conditions. Consequently, central banks were net sellers of gold. But as things have become decoupled, as we've just spoken about, you can see that for the last decade, central banks have become big net buyers of gold, with a very, very dramatic increase over the last 12 months, which is clearly correlated to the conflict in Ukraine. And whilst none of these things I've highlighted are good news for financial and political stability, they are positive for gold and go a long way to explaining my first message to you today, that is, do not forget gold. My second message is even easier to explain and something that I'm pretty sure most of you don't need much convincing of. That is, the copper price is going higher. Take a look at the chart on the left-hand side, which shows the copper demand from the growth of electric vehicles, which is only one component of the $125 trillion of new investment that is required to reach net zero emissions by 2050. So that's my second message. Copper is also going higher. My third message is that if you believe my first two messages, then the best way to get exposure to gold and copper is through an investment in Evolution. A quick reminder of who you are if you haven't been at the last 12 Diggers and Dealers. We've got a market cap of around $6.8 billion, a mineral resource inventory of 30 million ounces of gold and 1.8 million tons of copper, ore reserves of 11 million ounces of gold and 1 million tons of copper. Our 2024 production guidance is 770,000 ounces, and we pride ourselves on being a very, very low-cost producer at 1,370 Australian dollars an ounce, all-in sustaining cost. Also, a pride of ours is 20 consecutive dividends that we have delivered, and that's meant that our shareholders have benefited through over $1 billion of distributions to them. We have had a clear and consistent strategy. It's been built around the pillars of assembling a great team, focusing exclusively on Tier 1 jurisdictions, operating a concentrated portfolio of high-quality assets in very well-endowed, geologically prospective gold districts, and relentlessly seeking opportunities to improve the quality of that portfolio. We have strategically positioned ourselves in Australia and Canada. Both of these countries are undoubtedly premier mining jurisdictions rated near the very top by the Fraser Institute and the World Bank as places where the rule of law can be relied on. They are both vast, sparsely populated, mineral-rich, mining-friendly countries whose talented people, and that is a critical ingredient, have the skills necessary to build successful mining companies. What has exceeded our expectations is the quality of the portfolio we've been able to assemble. Our playbook has really been pretty simple. Our best opportunities have come from majors. They do establish themselves in the world's best and most geologically well-endowed mineral belts, but like all companies, they go through transitions, either because of strategic repositioning, M&A, or some balance sheet stress, where assets have become non-core and available for sale. In each of the acquisitions we have made, we've been able to add enormous value through the discovery of more ounces, as these assets have had their exploration programs curtailed for a number of years prior to their disposal. Not because of the geology, and that's a critical point. It's not because of the geology, but because of other corporate priorities. And geology is undoubtedly the foundation of any successful acquisition. The reality is that in our industry, for each ounce we mine, our asset base is depleting. And we need to discover or buy ounces. This is how value is created in our industry. Those ounces that we buy or discover have to be done at an accretive value to our shareholders. And our track record here speaks for itself. We've been able to add ounces to our mineral inventory at an exceptionally low cost of $45 an ounce. So now I want to share our portfolio with you. It shows you where we've come from and when and where these acquisitions were made, and how we've been able to create and add value to these acquisitions. So this chart shows a lot of things. On the x-axis is the mine life of each asset. We want our mine life to be at least 10 years, and we now have 4 core assets that have at least 15-year mine lives. The annual production is shown on the y-axis, and we are targeting a scale of production to generate strong margins and cash flow. The average rate of return, which is also critically important because we are deploying shareholders' funds, is shown in the bubble size. So when we acquire assets, we want to generate really good returns on our investments. And we also are very focused on the return and payback of these investments. That's both acquisition capital and subsequent capital, and that is shown as in the bubble color. So what we want is to get to the far upper right-hand side of this chart with big bubbles. That's our CEO's Laurie Conway's job, whose job it is to take what we've acquired with him and the team, and they're really in well positioned to do this, but to create value through the transformation of these assets. So what you're seeing here is our assets which were acquired at the time of acquisition. So let me start with our first the asset which is closest by us, where we hosted a large group of investors and analysts yesterday, and that's Mungari, just up the road from here. It's an asset that should have been nearing the end of mine life based on what was ahead of it when we originally acquired it. And the only thing that separated our highly efficient Mungari mill and our relatively small landholding from Northern Star's large area, which contained the Kundana and East Kundana mines, was the tenement boundary on the page. It was not the geology. And I think, Raleigh, you recognized that when we first had the discussion around the acquisition of Mungari. The acquisition for us of Kundana was an enabler to the $250 million plant expansion we recently announced at our Investor Day. And this has now given Mungari a 15-year mine life, allowing an improved and increased production rates, an improved payback, an increased payback, and return on investments. That's what we want to see in our assets. The expansion that we announced, this expansion to the mill, will deliver a very good 19% rate of return at a conservative $2,400 an ounce price assumption, and also an 18% reduction in our all-in sustaining costs. Every now and then we hear from some people that Evolution is viewed as an East Coast gold miner. But this major investment, right here in the goldfields, will position Mungari as a cornerstone asset, and we view this region and this community as being a core part of Evolution. Now I want to turn to Ernest Henry. We secured around half the economics of Ernest Henry in 2016 through the unique deal we negotiated with Glencore when they were confronted with an existential debt crisis. This was a precursor to securing 100% of the asset in 2021. Since then, an asset which didn't rank very highly for Glencore has had more exploration dollars spent on it in the last 12 months than it had in the prior decade. And the results are evident. We've doubled the reserves, and we now have at least a 17-year mine life with outstanding exploration potential ahead of us. It's been a huge and powerful cash generator. Since acquiring the economic interest in 2016, including the first 15 months of full ownership, the asset has generated a remarkable $1.8 billion to our bank accounts, and that's almost repaid our entire investment of $1.9 billion. And we still have a 17-year mine life ahead of us with great geological prospectivity. It is our highest returning asset at around 25% per annum so far, and the pre-feasibility study that we released on our Investor Day shows that the investment required to extend the mine life out to 2040 will deliver an even better return of 28% per annum at conservative gold and copper prices. Turning to Cowal, we bought Cowal from Barrick in 2015 when it decided that Australia was no longer a strategic priority. The asset should be finishing operations next year based on the asset's life when we acquired it. It now has a 17-year mine life remaining and is essentially fully repaid, including the underground capital. As the new $380 million underground mine ramps up and with Stage H now fully into ore, the asset is moving back into net cash generation mode. The average rate of return on this investment has been 16% per annum, which is at an average gold price materially below the current spot price. This return will increase as we move into this next extended period of cash generation. Red Lake has had a slow start due to the need for a significant capital investment to transform it after we acquired it from Newmont 3 years ago. Our immediate focus is to get Red Lake consistently delivering to plan and generating material positive cash flows before we embark on the next step to achieve higher production rates at the asset. With a 12 million ounce resource base, we remain absolutely confident that it will evolve to become a highly valued cornerstone asset of ours. Mount Rawdon is transitioning from a 20-year-plus gold mine into a really exciting renewable energy play. It fully repaid its investment many years back and now has a unique opportunity to convert itself into a multi-generational pumped hydro asset that could be very valuable to Evolution. But no, Duncan, we will not be coming back next year masquerading as a battery metals company. We are proud and loud producers of gold and copper, but what you're seeing at Mount Rawdon is essentially a free option to our shareholders. So looking at our combined portfolio, it is exciting to see that we have a suite of assets with long mine lives ahead, which are able to maintain the improved rates of return and payback that we have been able to deliver since their acquisition. Evolution is at a great stage as a company. Having invested heavily in our portfolio over the last few years and done the hard yards, we are entering a period of higher production, lower capital intensity. Over the next 3 years, we plan to deliver over $1 billion of additional cash before tax through higher production at sector-leading costs, lower capital intensity, and a restructured balance sheet. At the spot price, this potential cash generation increases to $1.9 billion. The priority for us has always been and continues to be margin over ounces, and that will remain our focus in our AIC for FY24 is guided at $1,370 an ounce. We'll continue with our cost discipline to optimize margin and manage the impact of ongoing inflation. In this high metal price environment, typically mining companies reinvest it all back in the assets. Our approach has been always to balance reinvestment with returns to shareholders, and we'll be staying true to this approach, and the benefit of higher metal prices will be banked. Now I want to turn to my fourth and final message. That is, if you want to work in a great company with great people, here is a personal invitation to you from me to join Evolution. We have a fantastic award-winning graduate program, which is fostering the next generation of leaders in our industry. People like Emma Stewart, who was in our first grad program in 2013, is now running our open pit mine at Cowal. After working in roles at Mount Carlton, Cracow, Red Lake, and alongside our COO, Bob Fulker. Another one of our grads, Zach Murphy, is now the Discovery Superintendent at Cowal, and I'm confident he will be part of the team that discovers the next major ore body at that operation. And there's also Millie Henderson, who is now part of the investor relations team and helped put this presentation together. She first joined Evolution as a graduate metallurgist at Cowal. These are the types of opportunities we are aspiring to give our people. We also want our people to act like owners. Last week, we celebrated the winners of our Act Like an Owner program, recognizing absolutely fantastic ideas that have been generated by our people right across our business that have made our business better. We are committed to making every person in our company an owner by granting shares annually so that every person is a shareholder of Evolution. We are also very values-driven, and nothing is more important, and it is an absolute non-negotiable that we demonstrate this on a daily basis. Our values: safety, accountability, respect, and excellence. But it's also fair to say that we're also a challenging company. And with a strong belief, we have a strong belief that by challenging our people, we provide them the opportunity to be the best they can be. And ultimately, we want our people's time at Evolution to be the highlight of their career. And I promise you, at Evolution, by joining us, we will take you places. Thank you very much. I'd be happy to answer any questions, but please do remember those 4 key messages.
Thanks very much, Jake. I think we're out of time, unfortunately, for questions, so you let off this time, but I think everyone knows where to find Jake if you've got any questions for him.